Aloha, everybody. Welcome to the first episode of the Homeowner's Journey podcast. I'm your host, Drew McDurmin. On this podcast, we're going to talk about becoming a homeowner, being a homeowner, the journey, and, from the beginning to the end. It's a never-ending list. And today, I have a special guest. There's no better way to start off your homeowner journey than with a loan officer. I have Tristan Castro here. He is a loan officer with CMG, and I'll let him talk about himself and kind of his journey on becoming a loan officer.
Thank you, Drew. So I've been doing this since 2005. So it's been a long journey. We've seen so many different markets, I should say.
Yeah.
So many different programs. And I would say the main thing that I do is I just try to find out what the person's goals are. And then based on that, we kind of figure out, okay, based on your goals, what's the fastest, most efficient way to get there, right? So you could qualify for multiple different loans, but finding the one that's most efficient for what you're trying to do, whether it's short-term and long-term, we try to figure out, okay, what's the most effective way to get you there?
I mean, and like you said, there's no two loan officers alike. Same thing, like there's no two real estate agents alike. And again, I've been using Tristan for multiple of my clients now. I love his work, and the reason being is he's very upfront and honest. And when you're making the biggest purchase of your home, you don't want any fluff inside of there. You want the real hard facts. He goes over their long-term goals, which again, the homeowner journey ship is a long-term goal, especially in Hawaii, with now being people are taking steps into owning a single-family home, 1 to 2 bedroom, moving into something bigger, maybe a CPR single-family home, or even a townhome that's 3 bedrooms, and then finally making your way to the $1 million median single-family home, right? Which
Crazy.
It's insane of how quickly it's made its jump, and this not only in Hawaii but in any state now. It's crazy. But yeah, I guess we'll start off with the basics of the basics. If you can just go over the most common loans you see, so like VA, FHA, conventional USDA,
So I think the most common one people hear about is conventional, right? It's you grow up, your parents tell you need a big down payment, save 20% down, go with that conventional loan. And when you hear conventional, typically you think, okay, I need a down payment, and then we're going to follow specific guidelines that each lender has to follow nationwide, okay? So you have your conventional loan, and then you have your government-backed loans, which would be like your VA, FHA, USDA. And each program will have its own pros and cons. You might even qualify for multiple programs, right? And then your loan officer comes in and figures out, okay, based on the ones that you qualify for, which one makes the most sense for you. Because they're going to notice that, okay, you can go conventional, and nowadays you can actually just put 3% down on a conventional loan.
A lot of people don't know that is you can go less than 20%. Everybody thinks, a lot of people, I should say, not everybody, think 20%. It's gonna help your monthly, but it's not the end all be all. I've seen people go 3 to 5%. Specifically with you, I've seen you go as low as 3%. And because I haven't worked with a lot of other loan officers, I love the work you do. The people that I have met, they can only go as low as 5%, which I was like, big up to you. You're able to get that 3%. It just allows more people in Hawaii to become a homeowner.
And I think that's the goal too. I think when governments build different programs and then conventional guidelines come out, what they try to do is they try to find a program that anyone can fit in. I mean, granted, your credit qualifies and you can afford the payment, right? You have the ability to repay the loan. We can find a program for you. So if you don't have a large down payment, you can go 3% down. If you have no down payment, we have that USDA loan, which you don't have to have a down payment. Now, a couple of things with that program. It's limited to the area.
Yes.
And then, of course, you can't make over a certain amount of income. And then the qualification for each program is a little different, which means minimum credit scores are going to be different depending if you're going conventional. How much down payment are you putting down for conventional? And then VA would be your military loan, no down payment as well, no private mortgage insurance, which is just, a separate insurance.
So, I mean, like you said, PMI, private mortgage insurance, for the people that don't know, again, correct me if I'm wrong, it's, of course, an insurance to back the loan that you're getting if it's less than 20% down payment that you're putting. So, it's an extra $100 to $200 depending on, again, like you said, many factors, credit score, how much money you have, job.
Exactly.
But yeah, like you said, USDA, kind of a basis. A lot of people haven't heard about it. In a general census, like you said, it's mostly on the rural parts, kind of, away from downtown, essentially, away from Pearl City. Yeah. So think of it, you're living from Waipahu to the west side, and then, of course, North Shore.
The funny thing is, so when we think rural, we think, oh man, I gotta live on a farm. Right? But when you look at the map, you see Waikele is on there, right? You see Royal Kunia, and then it goes all the way to like Waianae farmland. And then if you're going like windward side, it's Haiku Road all the way to like, Haula, Kahuku, all those places. So there are areas on the island that aren't rural, and then it does allow you to go with no down payment. You do have a small minimum mortgage insurance, but again, each program will have that except for VA.
Yes.
To go back on the conventional, you don't necessarily need 20% to get away from the mortgage insurance, but that's the standard. Typically, when people hear 20%, it's because they want to get away from the mortgage insurance. Nowadays, there's so many creative ways where you can get away from that. And I think that's one of the big parts, getting your trusted loan officer, right? Because if you just know about one or two loans, and you qualify for one or two loans, and they say, okay, this is what you qualify for. How do you know that that's the best thing that matches your long-term goals? Right?
Exactly.
So, like clients we work with, what we do is we take their long-term goals, and of course they adjust and they evolve, but if we can kind of know what you're looking to do long-term, you can reverse engineer it and say, okay, based on this client wants a portfolio of properties. Okay, what's the most efficient way? Might not be put the whole 20% down.
Exactly.
Right? You want to save some liquid. And then you have a family that says, you know what? This is going to be our forever home. I need the smallest payment so we can live comfortably.
Yes.
Okay, then let's try to figure out down payment versus interest rate and see what's the most effective way there. So, like you mentioned, the programs out there are great. There's not one that's significantly better than the other. It might just be significantly better than the other for your particular scenario.
Exactly. And like I was saying in the beginning, that's why I love working with you, is because you're there for the whole process. It's not just use you for your first home and then you never see him again. It's, this building wealth. Everybody's nowadays talking about buying real estate as a income, as the passive income. That's the popular thing. And, that's why, again, you have a loan officer. It's like the people that cut your hair.
Yeah.
They know your preferences. They know what you like. They know the ins and outs about your situations and stuff. So again, I think that's great that you mentioned it, and it's very informative. I think this was a great place to start off with. I guess going more into the VA and FHA, if you can give us the basis for each one, kind of the documents and requirements you needed, because USDA, it's less document requirements in terms of like VA, like you need military certification, and then FHA, I believe there's some other stuff possibly.
So anytime you go with government loans, there might be some extra things you might need. And it's going to be specific. So if it's military, whether you're active duty or you're not, whether you have your DD-214 or just your service documents, but within each one, you're still going to need the basics for your income documents. We need to be able to calculate if you qualify. Like what is the payment you're what payment are you able to pay back the loan at, right? So what's that qualification? And then because certain programs, government in general has typically a slightly lower interest rate, that changes the qualification too. FHA, I think the main thing with FHA, a lot of people like FHA because it's been around for so long. That one has a 3.5% down payment. So a lot of people like that. I think that the one thing to be cautious with FHA is if you're going FHA, why are you going FHA? Okay, because it might be the right program for you, but FHA typically has a little bit higher mortgage insurance premium. Okay. You're going to pay a mortgage insurance premium up front, which means there's a 1.75 fee that you pay up front that you finance into your loan. Even though you're putting down 3.5%, your loan amount's going to be adjusted upwards by another 1.75. So
Interesting.
even though you put 3.5, you're going to increase your loan amount by that upfront mortgage insurance. And then you're paying a monthly premium for your private mortgage insurance. So like conventional, if you don't have a large down payment, you're going to pay mortgage insurance. But you're going to notice, I heard you say this earlier, and this is exactly what it is. Depending what your credit score is, the mortgage insurance is going to be a little bit different.
Yeah.
The higher your credit score, the lower the mortgage insurance. Not with FHA though, it's set. It's a set monthly mortgage insurance. So
interesting.
You're going to notice that if you have good credit, typically you're going to see the loan officer hopefully recommend you go with conventional.
Yeah.
Because it makes no sense, right?
Exactly.
The other thing too is people say, well, doesn't FHA have a slightly lower interest rate? It does, but when you calculate that mortgage insurance in there, it's not necessarily that much lower. The key thing with government loans, whether it's FHA or USDA, is the mortgage insurance doesn't ever go away. Okay, like for USDA, it's a lot smaller and the mortgage insurance per month goes down, but it's based on your balance. Conventional, once you hit a threshold with enough equity, it goes away. So knowing long term what you're trying to do, right?
Yes.
You kind of figure out, okay, what are you trying to do long term? Because this mortgage insurance will not go away, which means if the goal is to maybe refinance out of it or do something creative to get out of it as soon as possible, then don't try to stay as liquid as you can, because you'll never make that money back, right? Anything you put into the loan, you'll never really make it back. Yeah.
Which is a great point, because a lot of time people think, again, first time home buyer, FHA is the way to go, but that's a great point. That's an interesting point that even I didn't know, that your PMI stays the same no matter what your credit score is and stuff. In addition to that, I know that there's only certain properties that qualify for FHA. So
just like VA.
Know, exactly, just like VA. And from what I've been hearing is there's more and more condominiums, which is very popular for first-time home buyers. Condos, townhomes, they're not recertifying themselves.
Very few and far between.
Exactly.
It's probably, if I had to guess, and I might be totally wrong, I'm just gonna say maybe 5% of all condos are FHA approved. So right, and typically, if the condo is in good standing or the townhouse is in good standing, meaning that there's not too many delinquencies as far as HOA maintenance fees, and the building is a good project.
Yes.
Okay, you can get conventional approval on it versus trying to get an FHA approval on it.
Exactly.
So again, talking to the realtor, talking to your loan officer who knows this kind of stuff is key, because imagine that you go in there and you're just talking to somebody who doesn't understand what's going on.
Exactly.
I think that's the scary part, because yes, you might qualify, but shoots, you might not qualify for the thing that could get you to that next goal, whether it's another property, whether it's getting a lower payment. Yeah. And I think, that's huge.
So, I'm glad we touched upon that. That you did remind me of that, about the whole FHA and how the buildings, again, were scarce on getting renewed. I guess we'll go on to, what can a hungry first-time home buyer do right now to prepare?
This is a great question. So this question is so good, because when you think of it, when you ask me that, I think of all the times I talk to somebody who's really wanting to buy. Yes. And I talk to them, and if you ask a lot of people, and this is common, it's not saying that people are bad, it's just common. When you say, okay, well, let's do an application, how much do you make a year? 90% of people will be like, I think I make this much. They don't know. What's your credit score? I think my credit score is this. I don't know. What are your bills every month? Well, I have this. So my point is, if you're a hungry first-time home buyer and you want to buy a place, know yourself. Know exactly what your situation is, right? Like, how are you you mentioned before, this is going to be probably the most significant financial decision, right, that you're going to purchase. Huge. You're going to spend hundreds of thousands of dollars.
Especially in Hawaii, right? They're, again, that median $1 million.
Right? So you want to spend $1 million, but you're not sure what your credit score is or how much monthly expenses you have. Like, and I'm guilty of it too, right? Sometimes people will say, well, what's your income? And I'm like, okay, well, if I calculate carry the one.
Yeah.
So I would say if you're hungry, just know your own situation, because you should know it better than somebody who's asking you for the first time. So, and the cool thing is there's so many apps, so many free resources out there. One of the big things is like knowing your credit score, right? I always tell people the credit score we pull is going to be different than what's on your app, but the app is still good because it monitors it for you.
Exactly.
Right? So if you're at a 760 on your app, you might not be a 760 with the lender.
Yeah.
But if that app goes up or down, it's a monitor.
It's consistently inconsistent.
Yes,
right?
but consistently.
Consistently. Like, weighing yourself every day, right? The scale might be off, but if you're going up and down, you know that.
Exactly. You know that you are the one.
Consistent. Yeah.
So knowing things like that, knowing your income. If your income is a salary, great. You probably know it. If it's not salary, which is 90% of people, right? There's a big difference between salary and hourly. Salary is no matter what you do, this is what you get paid. Hourly is, okay, I usually work 40 hours a week, but guess what? I get overtime. Guess what? I get bonuses. So just knowing your situation. And then what's your lifestyle like, right? Because to be honest, on paper, we're going to qualify you based on gross income and based on what we see. But you know your lifestyle. You know what you like to eat. You know how you like to go out. You know if you like to travel. So know your scenario. That's the first thing. I would say the second thing is, besides knowing yourself and knowing your scenario, is get your documents ready. Because you might have somebody who's ready. I want to purchase now. And I say, okay, here's what we need. 2 years tax returns, 2 pay stubs, yada, yada, yada. Oh, I got to go find it. I don't know, where did I put my tax return? And then it takes them time to find it, right?
Yeah.
And time is precious, because time is everything in this market. Time is everything. So,
people find a home, they love it, and then exactly. So a lot of times, and it's happened. I'm sure you've seen it. I've seen it for sure. Is people see a home, they say, I love it, I want to put it in offer, like literally 2 days from now or tomorrow, and then I gotta be like, whoa, let's take a few steps back. First of all, we need to get you qualified, and again, there's the documentation you need, and you have to run, all of these background checks, income checks with them, and it's great because people, from what I've heard, of course, I'm not a loan officer, it takes a while. There's a lot of stuff you need to do to get a pre-approval. An official one, not a pre-qualification where people are kind of just like, well, this is what you're qualified for.
Based on what you tell me, here's what you're qualified for. Versus based on what you showed me and proved to me, here's what you're pre-approved for.
Exactly.
Yeah. And on a side note, before I forget, I know this is a little off, but the market's been going up so much lately, and I hear this, and this might be one of those topics that people say, ooh, why do you talk about that? But people always bring up, well, is it gonna burst? And things like that. And the crazy thing is, when you think of it, the hoops that the lender makes you jump through from validating everything protects the market. Because based on what you give us, you can afford this. So the chances of you defaulting, the chances of anything bad happening are so slim that the market is protected. I think the last time something unfortunate happened was because the loans weren't as verifying as they are now, right? We didn't verify as much. So now that you have to make your payment, because the lender didn't do their job as good as they should have, now you might not be able to afford that payment. But in today's market, they get mad at us. Why do you need this? Why do you need that? And to be honest, it's to protect you. It's going to protect your investment.
Exactly. And, like you said, you touched upon it, is I heard there was like people were just giving loans for any amount. Again, they didn't care. They just wanted you to make your house purchase so then they could just make their commission run off and stuff. But fortunately now there's more, like you said, guidelines, restrictions upon yourself. So again, if you were a great lender back then, whoever was a loan officer, working with the goals, staying within your clients' budgets and stuff, today it didn't affect you because you're still doing the same ethical procedures. And again, like I said, that's why I love working with you and whatnot. But yeah, like you were saying, going back again to the process, first is to know yourself, know your expenses. Again, one of the things that I want to touch upon is, setting yourself a goal, a date to purchase your home. And people don't do that. It's like your homework. It's like, you just say, oh, I'll do it tomorrow, I'll do it tomorrow. If there's no end date, then you'll never get on the ball to get it. So if you set yourself a firm date that you want to have your home purchased,
write it down.
Exactly. Write it down, put it on your board, whatever you got to do, phone, remind yourself every day. So at least you know when it's approaching, you have to get yourself into gear. Then you can prepare your knowing yourself, gathering all your documents, getting all your expenses, knowing your credit score, and reaching out to the loan officer prior to even getting your goal, right? Reaching the goal.
That's the most genius thing. So we hear it all the time. Well, I want to buy a house in 6 months, so when the time comes, I'll get ready. Yeah. Right? When in reality, if you start today, even if you told me you want to buy next year, it'll give us time to kind of game plan with you and strategize, because the market changes. Yeah. You might not change. Your job might not change as much, but interest rates change, housing prices change, guidelines change. So getting your base and your foundation set early is going to help us kind of adapt to the market, right? So one scary thing too is most people think my credit is excellent, right? So you wait. Now we pull your credit and you realize, okay, it's not bad. It's 698, just say. It's not good, but it's not bad. But in the lending industry, there's different tiers on qualification, right? On what you qualify for. The person who walks into the bank that has a 698 credit score is going to qualify for something a little bit different than the guy who has a 720 score. Now, if we pull your credit early and we can check, within that time frame you're waiting, we can kind of help you get your score as high as possible. Even if you're not ready for a year, we can point you in the right direction and say, okay, if you're looking to buy in a year, and again, it could evolve. You could change it to 3 months, 6 months, whatever it may be. The earlier you start, the more you have time to put yourself in the best situation, whether it's your credit, whether it's understanding what your income is. And so income, here's a big one too. A lot of times, if you're an hourly or overtime or commissions, which, depending what industry you're in, you're going to have, they call it variable income, where sometimes you have double time and a half overtime, regular overtime, whatever it may be. Yeah. We're going to take a 2-year average a lot of times. So depending on when you get your qualification, we can tell you, here's what you qualify for based on today. If you're waiting 6 months, here's what you could qualify for in 6 months. But here's that sweet spot where we can use, year-to-date average plus this year, maybe the next year, or this lower year, the first year, drops off. We don't even need to use it. So I'll give you an example. If you're using 2019, 2020, and year to date, and your income looks okay, but your 2019 was a little low. Yeah. When you do your taxes for 2021, now we're using 2020 and 2021, and not 2019. Yeah. The two averages are higher. So, but planning that, right? Exactly. Is the key. Like the credit, the income, your down payment. Some people always say, I want to wait because I'm saving. I need 10% down. And the question is 10% of what though, right? Like 10% of what amount? Because again, the market does move. Exactly. So 10% of 500,000 is different than 10% of 600,000. So just understanding the whole scenario is as soon as possible is the best thing.
So I think, again, knocking that out, again, the concerns for the buyers while we're talking about that. Another concern is people getting their credit score pulled. They're worried that, hey, you're going to check my credit score, you're going to pull my credit, it's going to drop all these points, maybe I'm not going to be able to get it back up in time for me when I want to purchase a home, or it's going to set me back. I guess, is there anything, like your thoughts on that?
So 99% of the time, I always hear that. And it's fair. Yeah. It is fair. Because if you pull your credit a lot, it does take a hit sometimes. But you have to think of it this way. If we don't know where you stand, there's no way we can help point you in the right direction to get there. Another thing too is, say you and I are both trying to get pre-approved. And say you have a 740 credit score, and say I have a 660 credit score. Now we both get our credit pulled. The reason I have a 660 is maybe because I use my credit cards a lot. And the reason you have a 740 is because you probably pay off your credit cards all the time. Now when we both pull our credit, I might get hit more than you just because it looks like I'm more desperate for credit, because I can't even pay off my credit and I'm getting pulled for another possible liability. Whereas for you, you pay it off every time. So now when your credit's pulled, it might not even really change, right? Because you're already top tier. And the other thing too is multiple inquiries makes the person look like they're shopping
Yes.
Right? So, but if you just get one, and it's not from an auto dealership, which is usually a depreciating asset, but from a bank, like a financial institution, you're going to notice that it doesn't really affect you as much, as long as your credit is good. Now, if your credit isn't good, and you're afraid that by pooling your credit, it's going to get even lower, we need time to fix it anyway.
Yeah.
We need time to help your credit heal anyway. So the sooner you tell us, the more time we have to help you fix it, right? So why be stuck at 680 for the 6 months you're waiting, when if at 680 your score drops to 676, but you give us 5 months and we can get you to 780.
Exactly. Like you said, point them in the right direction. Give them the tools needed to reach there. And again, like you're saying, credit score is only one factor of many, right? Income, maybe if your income is good enough, your credit score may not affect it as much as you think it would. And all of these other possibilities. We won't know until you reach out to your loan officer to get the pre-approval. And like you said, you have the time to build up. I mean, this is a whole nother topic. Again, we could go on hours about this, about preparing and stuff. But again, it's knowing what your goal is, what type of housing you want to know. How much money is it going to be, right? That's why you need the real estate agent to go, all right, this is the home you want. This is how much it's going to cost. Right? Now let's go speak to the loan officer. If you already have the loan officer, you spoke to them already. All right, now your real estate agent and loan officer are working together to be like, all right, what does this person need to do to reach this point? Whether it's paying down certain loans, whether it's increasing your credit score this amount of points. And
so many different ways, right?
But, the fortunate thing is if you have two people, right, two professionals working for you to get that, then, all more power to you. For buyers, it's free to talk to us.
Build your team.
Exactly.
Right? Build your team.
It's, we're here to work for you. It's our job. We do it 24/7. For the most part, right? Me and him are talking to each other at the dead of the night. Exactly.
But
so again, we're here to work for you. Just reach out to your local real estate agent, local lender, and again, if you're working with the right people, then they're going to be on your side 100%. Trying to get you there and communicating with you on the way. So I love it.
Yeah, that team thing is key because, and people ask me all the time, right? Hey, Tristan, should I buy now? I'm only half of the equation, right? I can tell you financially on paper if it makes sense and you can afford it. But where are you looking to buy? What does the market look like in that neighborhood? And that's not my expertise, right? So I always tell them, you got to talk to your realtor because that's their expertise. Yeah. And then you combine those two on your sheet of goals and paper and you find out, okay, does it make sense? But if you have your team, the chances of making a mistake or making the wrong investment is so slim if you have the right team in place.
And again, it's just one step. It's just taking the first step, right? And people just got to reach out to setting your goal again first. That's the first and foremost. And, reaffirming yourself of, I want to purchase. When do you want to purchase? Let's start early. Just reach out to them. You can work on getting the documentation, work on getting the information from the people you need to get it from. Because then you set your plan in the future, right? And, if you don't want to buy at that time, no big deal. Just wait, right? Exactly. And you can wait longer. You can get in sooner. That's what we're here to do, is to work with you. And, do yourself a service to make that step for yourself on being a homeowner. And again, I'll make another video talking about the steps, the whole triangle about, purchasing and whatnot. But let's go on to one of the things that more so on being in escrow. What pushes back the closing date? So this will be for more people that they're in the escrow process, right? They've already got their loan. Their real estate agent did a great job. They got them into escrow. And now what can they do to make sure they stay in escrow? And a quick synopsis is escrow is just the process of you purchasing the home, becoming the owner of the home, from getting your offer accepted till getting the keys. And in that large portion, this is where the loan officer is doing a lot of the back work that you never see, never hear about.
30 days a month.
Exactly.
We're just pounding it every day, making sure the file stays clean and put together. But we do need your help.
Yes.
Right? So your question is excellent because if anything changes, think of it this way: we're pre-approving you based on everything you gave us. So if anything changes, which happens, unfortunately, even though we tell people don't switch your job.
Yes.
Right. Don't even change your work schedule. Some people are like, we're gonna get a house. Okay, let's go on vacation. And it's like, oh, you had so much overtime or whatnot, and we're using that, and now you're taking 2 weeks off. So while you're in process, just stick to the game plan. Stay as clean as possible. Don't take out any new debt, right? Because you cannot trick the system.
Meaning,
right?
Don't buy a new car. You know, you hear it all the time. People joke about it, but don't buy a new car.
Yeah. Wait till you have the garage and the house and the keys, and then get your new car. But you're absolutely right. It's one of those things where people think, okay, because I'm already pre-approved and because I have a approval, like a conditional approval, and I'm halfway through the process, I'm supposed to be getting my home keys next week, let me pick up my new car. They won't find out, right? And there's the system actually pings us and lets us know when your credit is pulled, right? And if your credit is pulled, we're going to ask you, okay, did you take out any new credit on this, right? This car dealership, did you purchase a new car? This new card that you got for furniture, did you actually take anything out? And if you did, even if you qualify still, because you're like, you know what, I make so much money, I can easily afford that, right? That new car.
Yes.
You can. Numbers wise, you can, but guess what? It has to go back into underwriting, which is like the judge, right? That says yes or no, because we have to have the numbers updated. Even if you still qualify, it takes time to get it updated. And think of it this way too. If you have a person working on approving a file and there's a long line of files, if you pull something out, they're not just going to drop this file and take yours and say, okay, let me update this one. It's going to take time to go back into the process. So don't change your job, don't change your work habits, and again, don't take out any new debt.
And man, you know, people again taking out these cars, they think they got the home and they run off, buy themselves a new 4Runner,
engagement rings, hold, okay.
Everybody just hold on, like you said, and everybody's trying to push for these 30-day closings, and you know, we're getting 30-day closings by the nick of time because of the whole appraisal backup, and you know, there's a lot of factors right now into that escrow officers, loan officers, realtors are trying to do right now to get you closed on time, because you know, as a buyer, if you're not able to close on time, it does affect you purchasing the home, right? Again, in the contract, if you don't have this extension, right, then if you have to default on the buyer's side, there could be repercussions. So again, staying on time, being in escrow.
One huge thing, and I'm going to speak for all the loan officers out there on this one. Okay, so for the client, when you're sending in documents to us, think of it this way now. You're purchasing something, whether it's a couple $100,000 to $1 million plus. The documents you give us, give it to us in a clear way, because we're fighting for you to get this approved, right? So which means if we say last 2 pay stubs, try not to go on your phone and it's just holding it and then text it to us.
Yeah.
We try to flatten it, we try to make it nice, but we're trying to present your best foot forward, right? We're trying to present this clean, clear file. And sometimes that holds it up, right? Because if we can read it, but the underwriter who has final say cannot clearly see because there's a crinkle here and there's a shadow here, the time we're waiting for it to go into underwriting, if we're on a 30-day close, they could come back and say, you know what, I need a clearer copy. It's our job, though, to understand that when we get it, but we do get some pushback sometimes when we say, you know what, can I get a clearer copy? And they think it's us trying to be, you know, ahead of it, when in reality, all we're trying to do is build the file as good as possible for you.
And that's a good point. Feel free to, hopefully your real estate agent, you know, is more than happy to go and pick up these documents. You know, I do it all the time. I'm more than happy to go down there, grab their documents, scan it myself, of course, if they're okay with it, and provide that. Or, you know, if they need a physical copy, I'll go and pick it up from them, from your house, go deliver it to you, right? Again, that's your job. As a real estate agent, you know, it's going above and beyond, and again, that's working together as a team 100%. To getting you the documents.
And most lenders, I'd say maybe all lenders, have like an upload portal that's secure. So it's not just emailing it over email. It's a secure upload portal. But that's way more effective than let me just take a picture and text it to this guy. You know, and we understand I can read it and I can do the numbers, but now when we build a file, that could hold us up.
That's a great point. I didn't even, think about that. Getting on to, I know this is going to be a big question to people, going about interest rates, APR, points, again, those three things, let's go over them. For interest rates, I know a lot of people think about, okay, let's say it's 3%. All right, is it 3% for the entire loan? Is it monthly? Is it annually? And, again, APR, people probably have.
So I was thinking, okay, we'll try to explain it real quick because we can go forever on this. And then I'll give you an example. So interest rate, depending on your program, right? If you're talking about a 30-year fix, it's going to be amortized over 30 years. So over 360 payments, it's a set amortization at whatever interest rates you have, right? That's your interest rate to pay back the loan, okay? Now, points is going to be something you invest in to get a lower interest rate, and I'll give you an example. And then APR is not what you're paying your loan back at, but how much did it cost to borrow that loan, okay? So let me give you an example. You walk into the bank, you come to me, and you're going to get a $500,000 loan.
Okay.
And you say, Tristan, what do I qualify for? I don't want to pay any points, and I'll explain points in a second. What do I qualify for? And I say, okay, Drew, $500,000, you qualify for 3%. 3% is your interest rate. You're going to pay back the bank the $500,000, okay? And you say, is there anything lower? And I say, well, there's a lower interest rate if you choose to invest in a point. 1 point equals 1% of the loan amount. So in this scenario, 1 point would be $5,000 because the loan amount is $500,000, okay? So now 3% at $500,000, or if you pay a half a point, which is $2,500, you could get 2.875. If you pay 1 point, which is investing $5,000 more into closing costs, now you got 2.75% for this example. So that's how points work. It's an investment to get the rate lower, to lower your payment. But again, does it make sense long term, right? Like long term, the lower interest rate, lower payment always prevails, but how long are you going to have this? What's your goal on this property? Now, APR, every time somebody calls me and says, oh, what's your APR? Technically, that's a good question, but it shouldn't necessarily be the question you're asking because what they mean is what's your interest rate, right? APR is an interest rate, but it's not the rate you're paying back at. So if you borrow $500,000, your rate is 3%, you purchase 1 point to get it down to 2.75, you paid $5,000 included in your closing costs. What was the total cost expressed as the interest rate to borrow the $500? Not to pay back, but to borrow the $500 because you have closing costs, whether it's title, escrow, lender fees. If we take the total fees and calculate it into an interest rate, that's your APR. So you have your interest rate you pay your loan back at. You have points where you could invest in to get the rate lower. And then you have your APR, that's your total fees to borrow that loan. Because it's not a free with no fees, right? And there are ways to get around that. But one example is, typically you're going to see if your rate says 3%, the APR is always going to be a little bit higher because it costs money to borrow money, right? Even if the lender credits you to pay for things, you're always going to see the APR. What was the total cost to actually borrow that? What's the interest? What's the closing cost? Did you buy any points? So fees in terms of an interest rate.
Awesome. And again, like you said, the interest rate, the 3%, is going to be based off of the $500,000. So I guess to make it in layman's terms,
amortized set on 360 payments.
Within, again, 30 years is most case, it's being spread out between the 30 years. Day one of your loan or your mortgage payment and the last day of your 30th day is payment generally the same. Because of the fluctuation in property taxes, what people, those fluctuate, and, if you have HOA fees and whatnot. But for the most part, like, again, your principal and interest, those are all the same.
So right? Principal and interest total cumulatively will be the same. Now, broken up with that payment, so say your payment is $3,000. And out of the $3,000 in the beginning, $1,500 is interest, $500 is principal. You're gonna notice as time goes on that changes a bit. But the total cumulative amount, 3,000 stays the same.
Yes.
Yeah. So that does not change if you have a fixed rate. Yeah.
Awesome. Yeah. So I mean, it's a valid question. Some people are their concern is like, okay, or they think that day one and 5 years in, okay, my payments is going to be lower, which is not the case.
Not the case.
It's
No.
the same throughout, and by that point of your 7, 10, even 5 years, depending on the market, is you might want to sell, and that's going back to the point system on long-term goals. If it's worth it, is it your return on investment, ROI?
100%.
Yeah, so it's a math. It's basically
correct.
Talking to your loan officer. How long do you have the property for?
Yep.
Is the point worth it? Are you gonna break even? Are you gonna save money?
Correct.
If you're not, then
sounds like a loan officer.
Yeah,
exactly.
Then I learn from the best. I was working with each other.
Break-even point, does it make sense? If not,
exactly.
then it's just eye candy. The interest rate is just eye candy because you want to tell people you got a lower rate. But for your specific scenario, it might not make any sense, right?
Yeah.
It might make sense to just have the lender pay your costs. Yeah.
So let's get into another one. Is investment properties. I know, again, going back to the passive income, people love to hear it. People want to have an investment property. There's multiple avenues to get there, whether you turn your current place that you own into the investment property, moving into something bigger and retaining it, or whether to just buy one outright. I guess we'll go with the later, just buying one outright. Let's say you own a home, you want to buy yourself an investment property. What are, I guess, the requirements, especially for down payment, income, and stuff like that?
So if you're going with a real vanilla, simple way to do it, right, and you already have your property, you're living in it, and you want to buy an investment property, okay, typically 20% down would be good. You do get some creative programs where you could put a little less down, but usually we like to say 20%.
Okay.
Most programs, and again, it's case by case, but most programs, and depending on the client, how strong they are, you would use proposed rental income, which means, of course, when you buy the place, you're in escrow, you're not going to have a renter. You don't have a renter yet, right? So how do you use rental income? It's proposed rental income. What happens is you pay the appraisal rent comp schedule to look at comparable market analysis for that rent, and they'll use about 75% of it. Now, depending what lender you go to, it might change. Depending what program you use, it might change, right? Whether it's a government program. Actually, you wouldn't use a government program for investment.
Yes.
But again, if you're going to... the reason I bring that up is if you're going to use... Because we have somebody... I have a client right now who has they own a home in the mainland. They didn't use their VA. Okay, they own a home in the mainland. They just got stationed here. They want to use rental income for that home and use their VA for this new one. You can do that, but the guidelines sometimes are a little bit different for VA and conventional on how much you can use and what documentation we need. But if you're just going to buy it outright, typically 20%.
Okay.
One other thing though is people usually, if you're buying an investment property and you have the liquid funds to put 20% down, there might be more creative ways to get it because investment rates are typically a little bit higher than conventional rates, whether it's about a 0.5% to 1%. Investment rates are always going to be a little bit higher. So there might be creative ways to utilize your equity in your owner-occupied home or whatever it may be to purchase it at a more efficient rate. The other thing too is if you're a first-time home buyer, and this is, sorry, off topic, but if you're a first-time home buyer and you're like, you know what, I don't have too much down and I want to get property that generates income. And 99% of the time you're going to hear people, which is true, say, well, that's not possible because when you buy a home and you live in it, you can't use the rental income unless it's a 2-unit property. Okay, if it's a legal 2-unit property, you can use proposed rental income from that second unit. One big one that people tend to use if they don't have a big down payment would be like FHA. FHA, you only need 3.5% down. If you get a duplex, guess what? You can use proposed rental income. So a lot of times you're going to see people say, oh man, that property is nice, but it's multiple dwelling, it's 2 unit. I need 15% down for conventional. Okay, well, why don't you try FHA? Well, FHA, put minimal down, right? Live in one, use rental income for the second one. Now you have a multi-unit property that generates income.
Interesting. So
creative ways. So many creative ways.
And like you said, again, 20% is the basis of it. That's what people are looking at. in addition to, if I'm not mistaken, is they look at how much liquidity you have in your funds, because again, if you're not renting it out, then you will have to support it. Again, 100%. It's the risk of owning the property. The lender's going to look at it, so that's another factor.
Cash reserves, assets, like how many. So, and depending on the size of the loan, depending how much down payment you put, the amount of reserves you need, whether it's 6 months, 12 months, 18 months, are going to differ depending on program and lender.
Awesome. I mean, is there anything else that you can think of? I give you the opportunity that you think is going to be valuable for people, again, looking to purchase a home, whether they own one or even in the future, long-term home buyers.
I think you covered everything I can think of for a first-time home buyer. That's great information. One thing I would suggest, and it's just an opinion, right? When you build your team of your realtor and your loan officer, and if you trust them, because of course you don't want to work with a team that you don't trust, but if you trust them, stick with them, okay? Because I get some calls sometimes, and you know they'll see one of my videos or they'll talk to their friends and they're like, hey Tristan, you know, so and so just bought a place from you, they said you're the best, I'm currently working with a loan officer, can you take a look at my things? And I'll ask them, you trust your loan officer, have they been good to you? And if they say yes, right, and they tell me what they're doing, I'm going to say, usually you want to stick with them, because I could give you a second opinion, right? But again, a lot of times the only reason people want to ask me is, what's my rate?
Exactly.
What's your rate?
Yes.
And in this market, the market is so busy and it's such a big thing, everybody thinks rate is the most important thing. And in today's game, it's like, rate, as silly as it sounds, it's not that important. It's getting the program and the place that fits you that's even more important, right? So it's almost like if you have a loan officer and he says, I can get you 3%, this is what you qualify for. You trust them, this is what you qualify for. And then you get some loan officer that maybe I haven't been doing it that long, and I say, oh, they can get you 3%, and you know what, I didn't even look at your things, but just send it to me, I can probably do 2%. And you're thinking, how's that possible, right? And a lot of people, unfortunately, they think, oh, I might as well try. But all that time you waste, right?
Yes.
You could have lost the place that you really love just to try and get somebody who's going to say they can do 2%. And then when they do the qualification, they're like, oh, based on what you gave me, you qualify for 3%. So you're going to notice all the banks are relatively equal as far as interest rates and whatnot. I mean, maybe a little different, but it's pretty much in the same realm. Finding the loan officer and the realtor team that you love and trust, that's more important than shopping around for an interest rate, to me.
Yes.
Right.
And like you said, you bring up a great point is, you know, have the people that you trust for the long term, because these people are going to be in your corner for years to come, again, from your first home to your last home. And that's why you got to make sure you decide wisely. Think about it. You know, people love to shop around, have these conversations.
Shopping around is good. Shopping around is good. It's always a good thing to shop around, but while shopping, when you find that person, you stick with them, because they're going to know your scenario, right? And they're going to know what's best for you, and they can present that to you, versus the next guy who's just promising a lower rate that can't prove it yet, but you're just going to waste time doing that. And again, in this market, like you said, you might see a house you like, but the time you get checked, that house is gone.
Yes.
Right. So.
And I just thought of one more thing is going over refinancing for some people. So again, now moving on to the people that currently own a home, you know, refinancing, you know, people talk about HELOCs and stuff. Kind of go over that.
I think if you're going to save money every month, it doesn't necessarily mean it's a good idea. It sounds crazy. But remember the calculation, right? So if you refinance, and I gave the calculation of, in 30 years, you're paying so much interest up front and whatnot. If you refinance and you save $200 a month, but it took you X amount of extra interest or X amount of closing costs to save the $200 and pushes you back another 10, 15 years, how much did you really save?
Yes.
You might not have really saved money. You might have just spread out an additional debt, right? Going to home equity lines of credit, I love it. And a lot of times people think, well, home equity lines, the reason I don't like it is because, you know, it might adjust on me or whatnot. That's true, but there are fixed rate equity lines as well. So you don't necessarily have to take an adjustable interest rate. You could take a fixed rate. But the reason why I always tell people, if you can, try to convert your mortgage into one big equity line, is because it saves you so much on interest. Not only that, but it gives you the ability to start planning for future goals. Mm-hmm. Whether you're trying to buy another property, the equity line will give you the ability to borrow back funds, right, for your down payment. The equity line will give you the ability to pay down your loan a lot faster, because whatever you put in, you can borrow back. But we can go hours on this. But I do believe that just because you save money, it might not be the best thing. So talk to your loan officer, get all the options out in front of you. Yeah. If you're saving this much, what's costing you to save that? How much time am I losing by saving this? Is there a better way? Simple interest versus compound interest. We can get into that on another one. Huge things you can do besides just a standard refinance.
And then for the home equity line of credit, the HELOC, kind of just for the people that don't know, it's kind of like just a credit card based off of your mortgage, right? Your equity that you built in the house, right? It's they're allowing you to use that money, and of course, again.
And you see the commercials, right? Like home renovations, take out an equity line. Pay for college, take out an equity line. And you can do that, right? But there are more efficient ways to just turn your whole thing into one big equity line if you qualify. It gives you maximum flexibility in case of an event like COVID or whatnot. If there's a shutdown, the scary thing is, think of it this way too. If we're working, say we work at, I don't know, a store, right? A store, and we're managers at a store, and we both have a mortgage, and we have lots of equity. And equity is just the extra, the value you have in your home that's not accounted for by a debt, right? So say we have $100,000 in available equity we can use. Government shuts down or our job shuts down. We try to walk into the bank and say, hey, can I borrow some of this equity because I'm running into a tough time? The bank's going to look at your paperwork and now you're not employed. We cannot qualify. But if we took out an equity line now and we have the ability to reach in anytime like a credit card for emergencies only, if we lose our job, we then don't have to go and apply. We already have our line of credit. So it's more of a safety thing too, like a safety net.
Okay. And again, the credit card thing is just a dumbed down version. It's a basic version. Again, going into the details, that's why you want to reach out to somebody like Tristan to go into, again, the refinancing, the home equity line of credit. There's different professions. There's an endless amount of stuff and knowledge that you need to know. That's why when there's certain stuff that I don't know, again, on the loan side, that's why I have Tristan here. And when Tristan, if he has questions about certain stuff about the home buying process or stuff like neighborhoods,
expertise,
purchase contracts, all that stuff, then he reaches out to the real estate agent. But I guess, do you have any other closing thoughts?
No, I think it's a great market. I think if you're looking to purchase, whether it's like you said now or next year, the best thing to do is just find out where you stand. And
making that first step.
Yep.
Awesome. Well, I want to thank you again for letting us take a deeper look into loans and everything that surrounds it. I'm sure everybody listening had a great deal learning about what you have to offer and the insight. If somebody wanted to reach out to you, kind of what is the best ways? Instagram, everybody has it, email, phone number, all that good stuff.
Yep, easy. So Instagram, Tristan J. Castro. But you know what? You can just email me. Easier, right? Okay. Email me, tristanc@cmgfi.com, or text me 808-429-7270.
Awesome. You heard that. Replay it back if you need that information. Again, I have his information. Feel free to reach out to me. I'll be trying to get this video on social media, putting it on Spotify and stuff. So feel free to reach out to me. And again, thank you very much, Tristan.
Thank you, Drew.
Till next time. Peace.